Morning, everybody, in person and on the phone. Welcome to Clinigen's full year financial results for the year ended the 30th, 2021. Thank you to those few who have joined in the room, on the phone and on the webcast. At this time, all participants on the phone lines are in listen-only mode. After today's presentation, we will conduct a Q&A session in the room and then through the phone lines, and instructions will follow at that time. Participants can also submit questions through the webcast page using the Ask a Question button. These will be answered by email after the call. Sorry, that was a bit of a script just because we're running a hybrid meeting here using multimedia. So, I have some people with me here. So I'm Sean Chilton, the Chief Executive Officer. I've also got Richard Paling, who's the Interim CFO and Group Financial Controller, and also Sam Herbert, who's the Group's Chief Operating Officer, who will be here particularly to input to the Q&A after the presentation. Next slide, please. The cautionary statement, as you know, is important to note this presentation contains information that are neither reported financial results nor other historical information. You can, of course, read the full cautionary statement if you wish, as these slides will be available on the website after the event. Next slide, please. So, while a challenging year for everybody in the pandemic environment, let's just look at some highlights. So while COVID had an impact on us, and for clarity, the reason for that is because we are a global business, we are geared to hospital-based activity, and we are focused on therapeutic areas like oncology and haematology. So it did have a general impact. But I do think that the reverse, when the pandemic starts to ease and hospital activity starts to come back, does put us in a good position. You know, those sectors, those therapy areas, and that global basis is very much a positive for the future. Despite the tougher environment, we have made real progress strategically and operationally. We've driven further simplification and focus across the business. We've simplified the business into two divisions: products and services, divested a core part a non-core part of the UK business in the compounding piece that we divested. And since the start of 2001, with Sam joining, actually considering he's only been here for 9 months, he's actually made a lot of progress in simplifying and improving our operational efficiency and our capabilities. We'll continue to simplify the business in full year 22 and make further refinements to focus the business in those areas we feel we have sustainable competitive advantage. Critical for future growth, I think, particularly in services, is expanding our business through winning more client contracts, more client business. And actually, we have had a very strong year, actually a record year, in terms of the amount of business that we've won. And I think it does demonstrate our ability to service clients, that we've got the right offering, and that we're able to demonstrate, as we will later on in the presentation, this synergistic effect from one part of the business into the other. We do remain a highly cash-generative business, with over 86% cash conversion, and it remains and will always be a critical KPI for the business now and in the future. Next slide, please. So I'm not going to steal Richard's thunder, but just to highlight the key financials. Net revenue was up 13% on an organic basis to 458.6 million, which was ahead of the guidance we gave for the year, reflecting a strong performance in winning and delivering business in services and good progress in developed and the partnered segments of products. However, adjusted EBITDA is down 5% on an organic basis to 116.3, reflecting the impact of COVID and a change in gross profit mix, particularly offset by good cost control. The net debt position and leverage. So the leverage position sits at 2.8 times, which is meaningfully below the group's banking covenant of 3.5 times. Clearly, the pay down of debt remains a key priority of the business, and we expect to deliver below 2.5 times by the end of this financial year and below 2 times within full year 23. Earnings per share down 15%, but again, to stress the key KPI, adjusted operating cash flow of 99.9 million, with extremely strong cash conversion in spite of investment in working capital associated with O&As. Next slide, please. It's important, I think, to talk about the platform we've built and what it means to our clients and customers. The slide demonstrates where the synergistic effect happens, but there are three fundamental long-term unmet needs and therefore drivers of why our platform exists. The starting point in some ways is millions of patients globally still don't have access to the medicines they need when they need them. R&D is increasing, but R&D is taking longer to filter through to the patient population. There are challenges in getting drugs to market and then actually making them globally available. Adds to the fact that an increasing percentage of the R&D is done by small companies, biotechnology and small specialist companies who don't have the ability or don't have the capability to be able to create and facilitate global access to medicines quickly and safely. Healthcare professionals are spending more and more time trying to find these medicines quickly and safely. So why do we exist? We exist to enable quicker and broader access to these medicines. We achieve this through a global platform, offering pre- and post-launch services from phase 2 in technical parlance to full commercial lifecycle management stages. Our services to pharma and biotech help save time and money, minimise risk and protect their reputations, and allow them to simplify their own partnering strategy because we're able to manage both licensed and unlicensed markets. We save time, which is pretty critical, and resource for healthcare professionals because we allow them a much more time and time-effective solution to finding these products that they increasingly need through our digital platform in particular. We have simplified the platform in the last 12 months into the two divisions to enable us to focus on those areas where we feel we add the most value and where we have sustainable competitive advantage. Having divested the UK compounding business in the second half of the year, we will continue to look at ways of further sharpening our focus in the products division. Next slide, please. So, in terms of markers of progress, KPIs, I think on this slide it summarises a number of things and does start to highlight the emerging synergies across the platform. So the starting point on the left-hand side, the strength and depth is represented, I think, about the number of client relationships that we have with pharma and biotech, 577, up meaningfully in the year, that use at least one part of the platform and have done in the last 12 months. What does that do? It creates opportunities, it creates a pipeline. This is at the moment, and plainly it continues to move, around 450 opportunities, with an unweighted value of over £180 million that we're actively discussing with these companies. So while, of course, the ultimate value of the pipeline depends upon timing and win rates, it's a strong medium-term set of opportunities that have been created. We want to move those relationships through the platform so they use more parts of the platform. And again, we have increased the number of companies that are using 2 or more parts of the platform up to 43. What is that doing in terms of cross-selling? So in the last 12 months, we've signed 10 new projects that came directly as a result of cross-selling, and that's 16 over the last 24 months, with a lifetime value of more than £5 million. Yes, you could say that in the context of our overall profitability, that's a somewhat small number, but I think it's indicative of the potential momentum that is building in terms of that cross-selling opportunity. And in terms of synergies, we do have a number of synergies. For example, in the last 18 months, the clinical services business has secured more than £2 million in packaging and labelling business associated with the managed access programme, with more opportunities currently being discussed. So I think we're actually happy with progress being made here as we start to see the value come through the platform. Next slide, please. So let's talk about the portfolio growth across the business that I mentioned at the start of the presentation, and let's look at services first. So we've seen an increase in both the volume and value of projects being won in this division. In clinical services, as you can see on the left, we've seen the volume of deals won increase by 19% and the value of won business increase by more than 50%. which we expect to see come through over the next 2 to 3 years. In managed access, we've increased the number of managed access programs by net 30, and it's the largest increase in a single year and the largest number of programs that we've ever managed. Importantly, in terms of wrapping other important services around those core, we are starting to see more programs involving our real-world data capture and management service, and that will be an important part of the extended service going forward. So now we've got over 350 opportunities across the services pipeline with a value of more than £80 million, slightly down on the half, but that's a reflection of the volume of business we closed out. And as is ever the way with the pipeline, it is a dynamic situation that continues to change, but we expect it to grow further. Next slide, please. Again, look at the products division and the segments of that. Partnered products, which we do see as an important growth segment in the future. Despite the impacts of COVID on Prolucin, the partnered products piece saw some really positive momentum, with a 12% increase in the volume of products in the portfolio. This is being driven by not just local licensing deals, where we've seen 16 new deals across the AAA region, but also exclusive unlicensed deals, where we've seen a 42% increase in the number of products in the portfolio. All of that has led to a 31% increase in net revenue in the partnered product segment in the year. If you look at some of the more important licensing opportunities in this segment, there have been some good milestones achieved. In January, we reported the approval of Hunterase in Japan, and we've now launched that product there. We rolled out, with Erwinaze, we rolled out commercial supply in the UK, as I think you know by now, and we supplied into 35 unlicensed markets. We are targeting further commercial rollout in 22, with the US in particular one of the key markets, and we'll talk a little more about that later on in the presentation. Next slide, please. If you look at the developed part of the portfolio, again, in the products division, strong growth in revenue within that part of the business, driven in the main by melatonin and glycopyrronium. Not just in the UK, but we saw the first international launches into the United Arab Emirates. And to continue to develop these products, we launched new strengths and formulations of melatonin in the UK, and both glycopyrronium and melatonin were submitted for approval across Europe, utilising the decentralised procedure, with further launches expected in full year 22. So we had said, even up to a couple of years ago, that we were going to internationalise these products, and they make a good contribution, and we're doing just that. We have another further 10 developed products in the development pipeline, with an estimated lifetime value of more than £45 million, with a potential of 5 of those coming to the market in the next 18 months. So if you take services and you look at some segments of the products division, we've seen real advancement, we think, in terms of portfolio growth in the year. But we have seen COVID headwinds, there's no getting away from that, which have impacted some areas of the business, most notably Prolucin. So we thought it was right to give an update on that situation, following quite a lot of the detail that we gave in June and July. Next slide, please. So in our last update, we talked about how COVID had impacted the US hospital referral network, resulting in fewer and sicker patients being referred for treatment with Prolucin. As you can see, the US is still being impacted by COVID. They are seeing rising hospitalisations across the country, and that does have an impact when physicians take into account what they're looking to prescribe. And if you look at Prolucin, which requires ICU facilities, it does remain quite difficult to report with any certainty the long-term impact for on-label use, and that's why, to remind everybody, we've been conservative, cautious, and removed this from our guidance this year. The graph on the top right-hand side shows weekly sales. Some of this we presented in July. As you can see, while there's been a small upward trend, the weekly sales data is still quite volatile. We are, however, seeing the autoimmune and adjunctive use for cell therapy remain pretty constant. It's true that due to the international nature of our business, it's likely that there will be ongoing pandemic impacts for us into 22, as many countries still struggle to normalise. But we feel we've mapped this into the guidance as we have provided. Next slide, please. So look, before I hand over to Richard, there's a couple of final slides to cover. One is looking at the foundations of the business and what that will mean for contribution to medium-term growth and success for the business. Governance of risk, we've refreshed the board. Elmar Schnee has joined as chairman, bringing significant leadership expertise and experience from the international pharmaceutical industry, with Sharon Curran and Ian Johnson joining as independent directors. They bring additional UK PLC and pharmaceutical experience to the board themselves. We've also rolled out an internal audit and risk function, another sign of our development and maturity as a global business. From a sustainability perspective, we've rolled out our ESG framework where we make 17 key commitments. Alongside that, we've signed up to the UN Global Compact, the UN Sustainable Development Goals and the Valuable 500. We have formalised our commitment to sustainability and being a diverse global employer. Thirdly, because it is fundamentally a people business, we've continued to focus on how we can maintain a thriving and high-performance culture, and a couple of important markers, I think. So we've increased the average training spend per person, and we have another 115 of our people that have graduated through the Management Academy. We will be embedding a job grading framework across the business, which we feel will provide better opportunities for career progression and make us an employer of choice. Last but no means least, next slide please. The digital component of our business, how we digitise our business. Some of which won't be immediately obvious, but actually will become obvious quite quickly. We've made good advances in digitising the business, both for our customers and internally for our benefit, in the form of data and analytics and a more enterprise-wide CRM platform. Together, those things we think will materially help support our future growth plans. Let's just talk about the external piece first. So we've now launched a full online self-service platform through Clinigen Direct in the UK first. What does that mean? It means a healthcare professional can register for an account, log on securely, search the portfolio, view stock levels and product information, add an order to a basket and check out. All sounds quite simple, but it's actually quite difficult to do. So now we've launched that platform that our customers will experience a materially faster service by using this platform. It's available in the UK for what we would call on-demand and own products, but in full year 22, we'll create local versions of the platform and add in the managed access programs so that Cliniport will become the industry or client-facing brand and Clinigen Direct will be the customer HCP-facing brand. Just from a metrics perspective, because we do and have shown these metrics consistently over time, just to look at the number of registered healthcare professional users on the platform, that went up materially in the year too. So internally, we've done a lot. We implemented phase one of a new or upgraded, probably is the better expression, enterprise-wide CRM. That's key to protecting our relationships with our strategic clients that separate us from the competition and support the joining of the dots, that synergistic cross-selling approach that we now very much have. We've also, one of the things Sam's done is bring in a data and analytics function to provide better insights into how we operate globally and where we can do better. Next slide, please. And I will now hand over to Richard, who, again, is the interim CFO, to talk you through the financial review. Richard.
Thanks, Sean, and hello, everyone. I'm Richard Paling, the interim Chief Financial Officer, and have been the Group Financial Controller since 2017. Firstly, looking at the group financial highlights, which relate to continuing operations and therefore exclude the UK specials and aseptics business, which was divested on the 30th of June 2021. Net revenue from continuing operations increased by 7%, or by 13% before currency headwinds, but we have seen a fall in gross profit of 3% on a constant currency basis to 198 million. Adjusted EBITDA is 116.3 million, representing a decline of 10% on a reported basis and 5% on a constant currency or organic basis. We've held the operating cost base in line with the prior year. Therefore, the 10% reduction in EBITDA reflects the lower level of profitability as a direct result of COVID headwinds on both our products and services business. After EBITDA, amortisation and depreciation charges increased by 5.3 million. reflecting the investment in IT and digital platform, offset by a 3 million reduction in finance costs, which benefited from the strengthening of sterling on the US dollar and euro elements of our borrowings. This equates to a fall in adjusted earnings per share of 14% to 55.9 pence. Our cash generation has been strong, with almost 100 million of operating cash generated in the year, a 6% improvement on the prior year, meaning 86% of our EBITDA from continuing operations converted into operating cash. This strong cash performance has meant net debt increased by only 23.9 million, in spite of making a $90 million CSM deferred consideration payment during the year. We propose to maintain the final dividend at 5.46 pence, resulting in a full year dividend of 7.61 pence per share. Across services, we've seen strong revenue growth of 15% to 218.9 million, driven by the clinical business with a strong weighting from comparator sourcing, whilst managed access net revenues remain flat overall, reflecting the impact of COVID offset by increased business wins. The clinical business, which accounts for 87% of the services division, saw net revenue grow by 18%, driven by new business across both the packaging, label, logistics and the sourcing offering. The clinical business is weighted towards the US and Europe, with our managed access business utilising more of our global platform. The services divisional EBITDA fell by 6% to 32.7 million, due to the changes in mix towards sourcing, but also due to the investment in business to support the high number of contract wins. As Sean noted, we have won a high number of new managed access programs during the year. However, the recruitment of patients into these programs has been delayed and subdued as a direct result of the pandemic. Turning now to the products division, net revenue has been largely flat at 248 million, with EBITDA falling by 14% to 90.6 million. This was largely driven by an 11% fall in net revenue in the owned portfolio, which accounts for 43% of the products division revenue. More specifically, the impact of COVID on Proleukin and the loss of Ethiol this year has been the main driver for the decrease, which was partially offset by the strong performance of the developed portfolio. In on-demand, we continue to see COVID-19 headwinds, especially within Europe, with a decline of 18% in net revenue to 47.6 million. In partnered products, we have seen good growth with a 31% increase in net revenues, driven by a rise in exclusive unlicensed contracts, the rollout of key products, and local in-licensing deals. We have seen a fairly even split from a geographic perspective, with strong growth in our AAA region, leading to rest of world accounting for 43% of net revenue across the products division. Now turning to cash flow, and the full year saw 86% operating cash conversion, with 116.3 million of EBITDA converted to 83 million of free cash. This strong cash performance is in spite of a 15 million working capital investment for the Erwinaze rollout, and is an improvement on the 72% conversion in the prior year. These cash flows have helped fund an increased dividend payment, capex investment for organic growth, and the CSM deferred consideration. Net debt before leasing was 317 million at the year end, finishing the year with leverage of 2.8 times EBITDA, comfortably within the group's temporary covenant of 3.5 times. Net debt was down by 13 million in the second half of the year, after funding 15 million of working capital for the launch of the Erwinaze partnered product. Net debt is expected to fall to below 2.5 times EBITDA by the end of financial year 2022 and below 2 times within financial year 2023. In terms of liquidity, we have healthy levels of headroom thanks to our 430 million debt facility, and we're well funded to pursue our organic growth plans. I'll now hand back to Sean, who will take you through the summary and outlook, including growth guidance.
So our goal, as I think, or I hope you know by now, is we've built a platform to deliver solutions to long-term unmet, underserved needs for pharma and biotechnology companies and healthcare professionals around the world, which is all about facilitating access to medicines. We've demonstrated today some of the significant progress that we've made in 21 in expanding our portfolio through increased partnering with pharma and biotechnology companies. This is an area of increased focus for us. In full year 22, we'll seek to accelerate that focus on areas of the group where we have growing and sustainable competitive advantage in the services division and in the likes of the partnering segment of the products division. Focusing on our ability to use the services division to identify opportunities to partner with pharma biotechnology companies using our platform from pre-approval through to the lifecycle management stages of the portfolios and the drugs they have. We are therefore focused on further streamlining and simplifying the product division and investing in that core business, which we believe will drive synergies faster and create long-term shareholder value. Next slide, please. So in terms of guidance, and you'll have seen this slide in previous years, we have the guidance that we've given of between 5-10% EBITDA growth, and the slide shows you on the right-hand side the key assumptions that go into that guidance. You will note, because plainly O&As is a contributor to that, we expect BLA approval of O&As in our quarter 2 full year 22 and commercial rollout in the US starting in quarter 3. There are obviously a number of other assumptions, like the continued conversion of the order book from services as we see more clinical trials coming back and the rollout of the additional managed access programs that we've now won, plus also the partnered products that we secured in full year 21. We believe we can deliver on this and build on the progress we've made in the year in setting up the business and the platform to make the most of the substantial opportunities we see. So that's the end of the formal presentation. I believe the way that the questions are going to go is we'll take them from the room first, and then we'll take questions from the line and from the webcast. So, who wants to go first? Max.
So, 3 questions, if I may. Firstly, just on O&As, just trying to get a feel for how the market is going to be developed now that we've seen this sort of effectively outage in the US of O&As compared with Rylays, and what sort of market share you're anticipating longer term between the 2 products in that market. Second question, just on strategy. Obviously, now I think reading your release, the strategy is more focused on where you can differentiate. In the services, most of those services seem to be differentiated. But in the product side, you're talking about partnered products, which does include things like O&As. So just to understand if product rejuvenation is no longer a core focus for the business, which was obviously the original key. And then thirdly, just on the managed access side or the services side, I mean, a great progress in terms of signing 30 new net new deals. Just wondered, historically you used to show how many of those were early access and how many were kind of maintained access. I remember back you had a BTG asset there that was a Campath, I think, that was going on for many years. So I just interested in how quickly that portfolio will roll over, how many are the early access ones, and how many are kind of longer, more durable type collaborations.
Okay. Look, let's do those in reverse order, and I'll take the last one. So you're right. The way that we used to categorise the unlicensed division was a mishmash of all of them, really. But actually, the way that it's now categorised, those maps are all early access. So the on-demand piece, that segment covers what we would have called global access before. So that longer-term maintenance unlicensed piece. So when we quote a number of managed access programs, that's all early access.
So Campath would be in that?
Campath would be in the products division now. In terms of O&A, Sam, do you want to comment on what the future might look like?
Yeah, so I think it's important to go through what we know about O&As in the U.S. and where we are. So it's public knowledge, we had a DSO shipment that went in end of June. That was 7,990 vials. We ran out of stock on Monday. You do the kind of math, that's around 700 vials a week. And that was in the face of Rylays being in the market, actively promoting, us not doing anything. So in terms of how Erwinaze held up against Rylays in that circumstance, it was strong. I think when we look about the comparison between the two products, we feel confident in terms of the amount of data that's behind Erwinaze, the administration, where we have Monday, Wednesday, Friday protocol, whereas they don't. The data doesn't exist today. And it's also been the standard of care for a long period of time. So there's no doubt that there is going to be a break in supply. People will use Rylaze. It's not that there's never been an outage of Erwinaze before. So we feel confident in the product. And the second part of that is when we look at the market, we think the market's significantly bigger than what's been tapped previously. And having two products in the market will expand that market. And I'm not aware of any one market where one product has taken the whole share. So we feel confident about what our share will be. Our guidance is conservative in what that amount will be. And if we look outside of the U.S., which is where most of the files are, albeit the economics are substantially different, the demand is higher than we thought, given the underserved market historically.
And then on strategy, it's an interesting way of phrasing it, Max. So strategically, even from IPO, I would argue that it was about services highlighting potential product opportunities. But you're right, for quite a long time, those product opportunities were predominantly acquiring what have mostly been small molecule products and then managing those and revitalizing them. So on one level, the reason why we use the word refinement is because it is. You still have the service division as it now is, creating opportunities to manage or to insight into the products we might want to have involvement in. That involvement, though, is much more around management, much more around licensing and distribution, rather than acquiring the products outright. And I think the fundamentally two reasons why that is more of a focus, I think, is because it is more difficult to identify those more mature products that you can derive value from. I think that the predominantly big pharma, which is where a lot of these are housed, recognise the value potentially that can be driven out of those and want to manage them themselves in an increasingly numerical way. But also, again, there is risk associated with these things around owning them, manufacturing, and the upkeep of those things. So the shift is because we feel that there are a lot more companies now that would claim to be specialist pharmaceutical companies that will look at these portfolios of older products. And I think that has changed over the last 3 years and accelerated meaningfully. So strategically, you look at where you can compete, where you can use your attributes to best value. And I think that route from clinical to managed access into these global management opportunities, it's still utilising the platform we've built in terms of the operating platform underneath it, regulatory, supply chain, etc. But I think layering on these products, Hunterase, Erwinaze, irrespective of what you think of Erwinaze, as Sam says, it will be an N of 2 products in a potentially expanding market. The capital allocation piece, I think, is also important, because plainly we spent some money over the years on these products, whereas we now have a situation where we can strike a range of commercial agreements with lots of companies. We can identify through the services platform what are the best opportunities for those and layer those onto the platform. So we think that will create a more consistent stream of revenue and profit and still deliver a very good long-term return for shareholders. Stefan.
Morning, it's Stefan Hamill from Numis. 2 questions, both on the partnered products business. I guess the most interesting thing you're saying is about the sort of future services focus. Did you not jump the gun in classifying partnered products as a service? Isn't it actually a high quality distribution service?
Well, you've just used the word service then, haven't you? In terms, I mean, and I think that's probably quite a good, another useful, interesting question, and Sam will definitely have a view. But did we jump the gun in classifying it as a product as opposed to a service? Possibly, but again, I think if you look at in 2016 when we had 5 divisions, which I will absolutely accept was complex, and everybody rightly said that's too complex, there's too many things going on, whatever the reasons were for that. We have been streamlining the business, and I think that education of what these things mean and how they are classified is important. I think there's a logical progression in terms of where we went from 3 into 2, and now we're refining what that products division means. But I think, frankly, what that products division actually really becomes is a more commercial product services business. By definition, because we're not owning the products themselves. But Sam, I don't know if you've got anything else to add.
Yeah, I think the delineation between the 2 divisions, regardless of what you call them, is the economic model. So the services they're being paid for by the manufacturer. Anything that's falling into the products is being driven by in-market activity. And whether those names are all right in terms of what we're doing is probably a separate question, but that's the kind of delineation. Now, those 2 groups have synergies, right? So even in a managed access setting, we're interacting with an HCP who is then also buying unlicensed. So you do have those crossovers, and likewise with managed access going from where the manufacturer is paying us to us sharing in the economic model from HCP and market-derived activity is that synergy. So there's an opportunity probably to clarify some of that, but it's just really the economic split that has driven those 2 divisions.
Thank you. It's really useful. Just sort of looking at it, I mean, 31% growth in this part of the business. I guess, that's fantastic, but I guess it's hard to separate from the Erwinaze arrival into the numbers. Could you talk about the growth here ex Erwinaze?
Yeah. I mean, look, we're not necessarily going to call out specific products, but, again, and Sam will have a view, but there are products, this is again why we highlight the likes of Hunterase, because while it's one country, products at the moment, Japan is the second, third biggest market in the world, and it's actually an interesting product that will create a decent amount of revenue and profit. So I think, yes, it's easy to focus on Erwinaze, and mathematically, just because it's a reasonably sizable product, I agree, it sort of overshadows quite a lot of things and skews it, but actually we do call out how many products we are now partnering with, where we are partnering with them. So there is no getting away from in the short term, Erwinaze is dominant, but I think there are other products coming up that will make a meaningful contribution. But Sam, I don't know if you want to make any other comment.
I don't have anything substantial to add in terms of, because we don't split it out.
I guess where I'm going is, if you look at this part of the business, ex Erwinaze, it's very interesting what the other products are. So there's 26 new products there. Yeah. And you'd imagine that it could compound on a sort of recurring basis. Yeah. Just interesting what that sort of compounding rate is, because that would drive the multiple.
Yeah, and I think that's something that we're going to need to, as we refine this and work through this process, I think that's the next stage of education for everybody, is what that will look like over the next 3 to 5 years, and what will come along with that is the shape of the business and what it looks like. I think I guess you'd not expect me to make massive comment on specific products, but I think the point you make is the reason why strategically we think it's the right thing to do. And again, it will depend upon our ability to do 2 things: continue to do those local licensing deals, because even if it's Australia, New Zealand, certain parts of Southeast Asia, they still meaningfully contribute as a compounding basis, and they're multi-year contracts. And then our ability to put more into Europe. While Erwinaze is the poster child for our European effort, there are other agreements we are looking at and hope to potentially close this year. And they're a combination of commercial agreements, which is part of the beauty of it. You can have a range of commercial agreements from, if you want to phrase it this way, full-on licensing through to, distribution plus models. So all that is the key point, that you can layer these things on, and I guess the point I'd make is we can and should do more in regions to match what we do in the AAA.
Yeah, I think if I just to add, right, within Partnered we have 3 offerings. We have the unlicensed offering, a distribution offering, which can effectively be everything up to holding the MA, and then we have full unlicensed products. our aim is to match our offerings with those product strategies. What we're seeing more and more is that it's going to be a combination of those solutions where it may be a licensed deal in one region, a distribution in another, plus an unlicensed tagged on. And if you look at Erwin-A's, that will probably evolve. Well, it's already 2 of those, and will evolve into 3.
Thank you very much.
Thank you. I'm going to sound like an auctioneer now, but is there any more from the floor? So I think we revert to, are there any questions from the line or the webcast or the ether?
Okay, it's a BT operator now, so if you would like to ask a question on the phones, you just need to dial star then 1. That's all you need on the phones, star then 1. And as a reminder, you can also submit questions using the Ask a Question button on the webcast page. And we do have a question on the phones, and this comes from Charles Weston from RBC. Please go ahead.
Hi there. Hopefully you can hear me okay. The sound is a bit funky on the phones. But I have 3 questions, please. First of all, the £80 million of net present value of contracts won. Can I just check, is that on a profit basis? Sorry, can you hear me okay?
It's a bit muffly, Charles.
Sorry about that.
I think it's your fault.
Sure how to improve it. I'll try and speak just a bit louder. You can hear some background noise as well. Okay. Just with regard to the 80 million net present value, can I just understand that is the present value of the EBITDA that those will generate? Second question, in terms of the BLA filed by Porton, when was that filed, and do we have a PDUFA date? And third question, on COVID assumptions just within your guidance, particularly on services. Obviously, you won a heck of a lot of services contracts. The business appears to be, or they would have done very well had COVID not materialised. So within your 5 to 10% EBITDA, what are you assuming with regard to the continued COVID headwind in services specifically?
Richard, do you want to take the first one on the 80 million NPV?
Yeah, so the NPV is based on our expected cash flows. So it's in effect an EBITDA profitable measure of the discounted cash flows.
Thank you.
Just on BLA.
The 80 million in the services that's highlighted on slide 7, if that's referring to, is combined estimated lifetime value, which is gross profit.
Okay. Just while you're on, Sam, then, the BLA Porton.
Yeah, so the BLA filing, it's been filed. We do have a PDUFA date. We're not disclosing that. It's on that's being handled by Porton, but we do have one. And what we've said today reflects our expectations.
Yeah, and then COVID assumptions, Richard, on guidance.
Clearly, there's a range. We see a steady improvement in demand as we go through the year, but clearly we are still facing headwinds, and we've assumed that within the numbers. So we've assumed a steady improvement as we go through the year, but still impacting across the business in terms of the global footprint that we have.
Depending on how clear the line is, Charles.
Follow up on the Erwin-A's side. Sam, you pointed out, I think, the Monday, Wednesday, Friday versus every 2 day difference between Erwin-A's and Riley's, and obviously the IM versus IV difference as well. Jazz has certainly said that they're looking to work on both of those. Do you have a sense of when they'll be able to publish data on that? Will you have Erwin-A's back in the market before Jazz has a more sort of competitive label?
Nothing firm on that. But yeah, the IV-IM piece is another important aspect with them only having IM, which I didn't mention earlier, but thank you for calling out.
Thank you.
Okay, there's no other questions on the phones at the moment, but just to remind everybody, if you would like to ask a question on the phones, you just need to dial star then 1.
I think if that's the case and there are no more takers on the lines, then thank you everybody in person and on the line for your time, and have a good day. Thank you.